Okay, good afternoon, everybody. Today is May 6th, 2022. This is your weekly take on the market. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Take a moment to read the disclaimer. I'm not licensed. Nobody at IBD is licensed. We don't issue buy, sell, hold recommendations, provide research, education, teach you guys how to fish on your own. Okay, so I have a lot to talk about, especially market related. So spend a lot of energy there. Probably very little energy in the industry groups. Nothing's really changed in the industry groups. And then talk about a few stocks and then the quote of the week. So I've seen some, I like to scour Twitter for just sentiment. I think Twitter is a great place to get a feel for sentiment. Are people bullish? Are they bearish? Are they worried? And it's nothing is perfect, but there are some little tiny tidbits. There's a lot of noise on Twitter for sure. There's some little tiny tidbits you can pick up here and there. And almost all of the screenshots, if you see a screenshot, I probably got it from Twitter. I will definitely like to give credit where credit is due. So I don't like to, if I miss somebody, I apologize. But this is a screenshot of inflows to stocks, B of A Global Investment Strategy. And you can see in the 2020/2021 period, it was just monumental, right? There's just so much liquidity, and it all basically found a home as a general rule in stocks. And that's why we had, an epic run in 2020. It's just an amazing run. 2021 was just okay. It started to really slow down. And so far 2022, that, the Fed has taken the punch bowl away, so to speak. And, this is the problem. There's so much money that found a home and in places that, just in hindsight, when you look at it, it just didn't belong, right? And so the SPACs, a lot of companies that came public that probably should have never come public, and stocks that I bought and sold like Path and AI and APPH. It's incredible, some of the stocks that I traded and how far down they've come. And those are just, those are ancillary names, the really good stocks, the PayPals, the Shopify's, the great companies, they've gotten torched as well. So it was a misallocation of capital. We're paying the price as we sit here today, unfortunately. This is from the CMT conference in New York. This was on YouTube, and I was just going to grab the screenshot, or I should say, rebuild the graph, and I just got sidetracked. I've been very busy, and I'm on Ali's YouTube channel later today, so I apologize. Hopefully you can see this okay, but also it gives me a good place to give credit where credit is due. We've all heard the term "sell in May and go away." Well, here's the mathematical facts. November to April, average Dow performance 7.5%, and May to October 0.8. Hypothetical investment of 10,000 is worth 1.3 million if you only invest in those periods, and $3,422. Is that correct? 3,422. Maybe this is in. Maybe that number is in millions. Yeah, so 34,000 or something. Something like that. But you get the idea. You did a lot worse. Does that mean that this period, it's like a coin, a loaded coin? If you have a coin that comes up heads 80% of the time, and I allow you to bet against me, you could break me as long as you manage your bankroll, even if it only comes up heads 60% of the time or 55% of the time. As long as you're betting a certain amount that you don't go over the top and go broke, you could break me doing that. So it works, but doesn't mean it has to work every single time. But keep in mind, we're entering that seasonal period where it's usually not very good. But this has been a really, really bad market so far, like really bad, historically bad. And so there are some factors that give me pause that maybe it's a little long in the tooth to the downside. We're in a bear market. I've been saying we're in a bear market for a long, long time. And when I look at the amount of money that flowed in compared to other periods, my gut instinct is it's going to be a longer bear market and worse than typical. So if a typical bear market's 20%, I think this one's going lower than that, but it doesn't mean I'm right. The 50-50 stock bond portfolio has just gotten trounced, and it's not great when you see this type of performance with that type of a portfolio. You can see there are some historically bad years in there: the Great Financial Crisis, the 2000 .com bust, long-term capital Asian crisis. But we did come out of those periods, which led to massive new bull markets, every one of those. So this bar, it's a few months long. So maybe we're halfway through this or something, compared to some of these other bars, like the width of it. How long does this type of underperformance usually exist? The old days, if you had 50% of your money in bonds and 50 or 60-40 was kind of the sweet spot. But just to make the math easy, let's do 50-50 for me. If you have $100,000 and 50,000 is in bonds and 50 is in stocks, and your stocks go down 20%, you lose 10% of your whole account. But normally the bonds would fill in that hole a little bit, right? So the bonds might go up 3%. So your overall loss is 7%. That's, that's survivable. But this year it's 10%, 10%, or 15%, 15% for both of them. And therefore you're down double what you might normally be. And so the bond market really has been the straw that's stirring this drink. The bond market is really bad. I'm not a bond expert. I look at it. I have a cursory knowledge of it, but I don't buy bonds very often. If yields get high enough, I might start to look to do that, but I have a friend who's really good at that, so I'll have him walk me through the trades. But it's just been a historically bad period for that type of combination. Tiger Global, one of the great hedge funds. Tiger is like a family of funds. There's a lot of really good funds that filter down through the Julian Robertson Tiger family. He would seed those guys, and off they would go, and a lot of them did extremely well. But Tiger Global was down 15% in April, down 43% for the year, 43% for 2022. The Nasdaq's down 20, the S&P's down 8, 10, 12. This is the real truth out there. This is a $20 billion fund. Well, obviously not any longer. And they're down 43%. They are down 48% off their what's called a high water mark. And Mike Novogratz tweeted, it's very important. That's what HWM is. It's your high water mark. And this is why we cut losses, because the further down you go, the more trouble it is to get out of the hole. If you go down 9%, you need 10% to get even. If you go down 20%, you need 25% to get even. Now, it might not seem, it might, like at first glance, it might like, why is that? Well, if I have a $100,000 portfolio and I take it down to 91,000, and I go back up 10%, let's say I go down 10 and up 10. Well, I only have 91, right? So I only went up $9,100. So I'm still underwater, right? I didn't quite get all the way to back to 100. You guys, I might have messed that math up, but you guys get the idea, right? Because the gains are coming on less money in the account. If I turn 100 into 80, how do I fill in that hole? It's got to go up 25%, right, to make that money. If I go to, and the easiest one for people to understand, it's real simple, right? If I go down 50%, how do I fill in the hole, right? If I go up 50, if I turn 100 into 50 grand and go up 50, I have 75,000 now, right? So I've got to double my money. So that's why we cut losses, just because it's so hard to get out of that hole the deeper you go. And most of the portfolio managers at William O'Neill and Company, they really start to get diligent. My experience working with them and asking them questions is 10%. 10% is kind of their number where they start to say, you know, cut back, reduce exposure, maybe take a break. Because if you're down 10%, you make 11, you can make that back. You get down 20, 25%, it's a long road home to fill that hole in. So they always like to stay within shooting distance of their all-time highs. I prefer that. Like my equity curve, I like more of a smoother equity curve. Now I give up some of the gains in exchange for that. You have to, you know, there's no perfect answer. So I'm cutting off some of these periods where things are really running. If I'm trying to reduce exposure when things are really good, then, you know, and it continues to be good, I might underperform a little bit that year. So there's no perfect answer, but I like it that way because I find that when you get in a hole, it's really hard to recover from. And, you know, it's unlikely that these guys, I don't know, it seems unlikely that they're going to stay in business because, you know, that's how they get paid, with the high watermark. What a high watermark is, if you run a hedge fund, if I'm running a hedge fund and I make you $100,000 on $1 million, let's say, I'm going to keep 20, you know, as the firm will keep 20, let's say 20%. So I keep 20,000 of that. Now, if I lose you 20% and then make you 20 again, I don't get paid, you know, on that 100,000 I made you back, right? I've got to fill in that hole first. You're always only paying me on money that you've netted, right? You're never going to pay. So a high watermark means if you had $1 million account, now it's at 800, you're never going to pay fees, at least the performance fees, until you get above $1 million. It could be a long time, if not forever, for these guys to dig out of that hole where they're not going to get these performance fees. And they have analysts that might decide to move off to the next hedge fund. Some guys might say, you know what, I'm going to go off and do it on my own. And, you know, and it's can become, you know, pretty tough to maintain. That's why a lot of them will close shop reluctantly, probably don't want to. I haven't heard if they're going to or not, but that high watermark is a big deal for hedge funds. And the hedge funds, they're all loaded up in all the same names. So that's partly why it's been so tough for these. And I've talked about it before with like Apple, with 5% of Apple or the Swiss National Bank owns, you know, 5% of their assets are in Apple. I just don't know who's left to sell to if the central banks own stocks. I guess the governments or you know, some alien life forms, which I joke about, you know, if they come down and buy that. So I just think these stocks are overowned and they're going to be waterlogged for a long time. Okay, I'm sorry. I apologize. I wanted to pause my notifications on Slack. I don't know if you guys could hear that or not, but it's driving me crazy. Sorry. Okay, let's talk about bonds fairly quickly. It's the worst bond market since 1842. That's pretty bad. That goes back a long way. Here's a, you know, a short picture of the TLT, which is down, you know, 27% off of its high, and just relentless. Just cannot seem to get a bid. And it's causing a lot of heartache for the stock market. The famous adage, "Don't fight the Fed." Fed seems serious about it this time, and they're going to, you know, not come to the rescue, so to speak, at S&P down 12%. Maybe they do at S&P down 20. S&P down 30. I don't know. S&P down 40. Seems unlikely they would let it go down there. They'll pivot, but I don't know. And I don't care. It's way above my pay grade. It's stuff I think about, but it's not stuff I trade on. I never make decisions on something like that. But I'm just trying to build a bigger picture. And until I see the bond market catch a bid, is what I like to call, or just stop going down, it's hard for me to be bullish. I might be a lot less bearish because the market's oversold, and I'm worried about short covering rally like we had a few days ago on the Fed news. That was tough to stomach. I was tiny bit short, and the stocks I was short just ramped up into that news. But it lasted a day. Lasted one day. The next day they all collapsed, and back to lower prices. All right, let's pull up the indexes in MarketSmith. So here's the NASDAQ. We've been closed about 15 minutes. It should be close to close. It's the worst low, or it's the worst close this year. We've undercut all the lows, so it's pretty bad. The 3 waves down is going to play out. The problem is, it's like, where are the waves? Maybe this wave is too short. So I'm starting to think that this was wave 1. Up, this is wave 2. We probably get some kind of thing, and then maybe we get a wave 3, which ends it all. That would be pretty disheartening for most people. I don't know that, the average stock has just gotten destroyed. So it's hard to see, that type of destruction in the indexes, but I'm open to it. But yeah, this is wave 2. It's possible 1, 2, and this is wave 3. Maybe. The only problem I have with that is this. It's just not enough, right? If you were short this, it just was too much. You either have total conviction and you're just not covering then if you were able to stay short that. That's a big rally. So my instinct is 1, we're in the midst of 2, we're gonna get some kind of rally eventually. And then I don't know if there's a third one or not. But the NASDAQ is the weak sister, and it's really struggling. Let's look at the S&P. Oops. I need to fix that. Wish that wouldn't do that. So you can see the S&P didn't. It's probably the lowest close, but you can see it had a tiny bit of a tail. Didn't quite take out the lows. Look at the relative strength. This is versus the NASDAQ. You can see it's holding up better, and we've talked about 100 times why. Energy, industrials are in the S&P. They're not in the NASDAQ. So it owns some stuff that's, keeping it up. Russell, let's look at that. A lot like the NASDAQ, worst close for the year. Let's go to the weekly. If you want me to think out loud, I know I've talked about it. This is the COVID move. I just don't see. I don't know. That seems like way too far down. But the follow through day on the COVID was here, somewhere there. So 1, 2, 3. If I'm thinking out loud, I mean, the average stock, allegedly really good companies, has just mauled the COVID bull market. So there's Shopify, the COVID bull market, gone. PayPal, COVID bull market, gone. C Limited. Yeah, congrats. You're up 13% or 22% or something. You've given it all back. Melly, how about that one? A little bit better. What else is out? And you get the idea. I could go on and on and on. How about NVIDIA? That's kind of one of the best ones. A lot better. But most of the stocks have gone down and erased that whole COVID move. So it feels like it was an overthrow of the great bull market we've been in. Been in a bull market for a long, long time. This is a monthly chart of the NASDAQ. This is the 2009 low. So you have a tiny, tiny correction / bear market there. This one was a little tougher. I remember Facebook back then. I was in that. It got hit really hard on earnings. The COVID bear market, short but nasty. You wouldn't have been able to survive that. I know, most people went to cash and something like that. So, but the NASDAQ is, forget where it bottomed, but let's just say, let's just call it 2,000 to 16,000, went up eightfold. So it's entitled to some type of correction bear market, like a real one. This was too short, I think. This one was long enough, just not deep enough. This one was too short and not deep enough. So it's funny how too short, not deep enough, not deep enough, but too short, and so I think we're in the process of both. We'll see. All right. Okay. The industry groups. And for the sake of brevity, what am I looking at here? 20 minutes. I'm going to go through this pretty quickly. I don't remember looking at last day or two, but I'm going to guess it's very, very similar to what it's always been. Energy, coal, chem ag, check, oil and gas royalty, oil and gas, oil and gas, oil and gas, oil and gas. You get the idea. No changes. Nothing's changed. I haven't seen any transportation ship stocks are holding up pretty good. I own a couple in that area. I like to keep something long, especially when I'm super bearish, because it makes me think and gives me feedback. But I have a little bit of exposure in that group, and that's it. And then two shorts. Well, three, one, including the market short. So it's just the same story here, and so it shouldn't be that different. Okay, talk about some stocks. Zim is trying to build a base. Not quite cuppish enough on the weekly, but definitely on the daily. I like that. Acting really strong. I like the shakeout. I actually bought the shakeout. So it comes down, makes a new low, comes back up below that. Kind of a shakeout +3. That's how I would buy that. I'm not waiting all the way to 79. I might buy more at 79. Fast forward 3 weeks from now, but I'm not waiting for 79. Just huge earnings and sales, and this pays a dividend. You can see here the last dividend, so you have to kind of understand that maybe it doesn't go anywhere and you collect a dividend. That could be a possibility, but this has been a really good stock, so that one's holding up really well. And then in the transportation ship, well, I guess this isn't really in that group. Transportation pipeline group, but kind of the same idea, right? They ship natural gas. So FLNG is holding up really well. I don't own this one anymore. I sold into the strength, most of it, and then sold the rest on the way down here, but holding up really good. GLNG, I am holding this one, trying to keep it. Looks, I hate to even say it out loud, but looks fairly high tide flaggish. Runs from 12 to 26. This one looks pretty strong. And, I'd probably add if the market's okay, if it got above 25. That's why I've cut that trend line. So, but as far as damage, the Zscaler is, looks like the game is over. CrowdStrike, which was holding up so well, or comparatively. How about Schwab? That was a stock I was really disappointed in the way I handled it, because I bought it right in there, but just all the way back. So there's just no place to hide. The last stocks to hold up: Apple, relative strength of 84. The relative strength line's within a stone's throw of new high. At the stock's below the 200-day. goes to show you how bad everything else is. Um, this is just kind of the last bastion of hope. And historically, they get the generals last, so to speak. So I think Apple, Tesla, Amazon, Netflix, and Netflix has already gotten hit. Facebook Meta has already gone. They got those already. So this would be the next. These are like the two last super generals that are holding up, Tesla and Apple. So maybe I'm swimming upstream because they're such great companies and have been such great stocks. I think that they'll get these two. If I'm wrong, I'll get stopped out. That's fine. Nice thing is I don't expect them to get bought out. So, that's one of the reasons I prefer to be, if you're going to be short individual stocks, you want to be short, big, liquid. I'm not trying to get rich being short. I'm just trying to get a feel for the market. And maybe if I get it right, I'll make some money, which is fine. I have been short a stock that got bought out one time before. So that was pretty painful. So it's something I think about if I'm going to be short individual names. I just don't know who could buy Tesla out at a trillion market cap. Well, it's not trillion anymore, but it was. And then I know it's setting up in a couple of handle, but it's a pretty flawed base. 42% deep and 29% handle. That's not within the parameters. So we'll see if that holds up. All right, let's go to stocks to watch. Let's go to the quote of the week. Richard Russell, who wrote the Dow Theory letters. I used to get his letters. I liked Richard Russell's thought process and the way he wrote. He was a old market veteran, and he says and I'm quoting somebody quoting him. I couldn't find the perfect quote that he wrote, but somebody on a podcast quoted Richard Russell as saying, so the hardest thing in the business is to stay in a bull market from beginning to end. Check. I find that very hard. The second hardest thing is to stay out of a bear market from beginning to end. Check. That's pretty difficult too. So we're in a bear market, and you want to stay out. Does that mean completely out? No, but you don't lose your mental capital. Stay the course. If you want to, pick some spots where you think you could catch some of your favorite names. I know Bill did that a lot. He would, in bear markets, find a spot where he might buy Apple or Google or Lululemon and just see if it would work. And if it doesn't work, it just moved to the sideline. I don't know if it's never been confirmed. It could be urban legend, but allegedly, let's pull up the chart of Apple in the 2009 bear market. And Justin has confirmed with me, and I think he said it public, that he couldn't remember Bill ever buying a stock below the 200-day or the 40-week line. He couldn't recall that, but he allegedly Bill was buying Apple down here. So, he might try there, he might try there, he might try there, he might try there, and he might try there. And he tried like a dozen times until he got it right, until he got a toehold on the stock. And then it started to trend. And, maybe he has a purchase there, a small position. Now he's going to ignore the 8 other losses here. They're all small losses, but he has a little purchase there, and then maybe he buys a little bit more there and a little bit more there. And let's fast forward. Oops, not that far. I apologize. 12/1/2009. Let's just fast forward. And you've got like a little flat base breakout. You could buy there. You've got some tightness. You could buy there. Oh, it builds another flat base. And now you've got the best name and just a stranglehold on the thing, right? You have a little bit at 100, a little bit at 120, a little bit at 140, a little bit at 160. It's not going to be perfectly like that. Believe me, I've tried to do that. It's really hard to do that exactly like that. But if I get this trade 65, 70% correct, that's pretty good. I could live with that, right? So that might be how you handle that. If there's a name that you just really, really love, but overall the market's really bad. And I think the first signal will be just some lack of new lows in the bond market. The bond market is really it just feels like the lack of liquidity in the bond market is a problem for the overall stock market. All right, so contact information, marketsmith@investors.com, 800-831-2525. Have a great weekend, everybody, and we will see you next week. Thanks, bye.